about pharmaceuticals? That's another space where people had such apprehensions. But in the last 6 months, we've seen a dramatic correction in Indian pharmaceutical names. I did see a couple of names in your portfolio, in your India portfolio there from pharmaceuticals. What do you think about that space?
That is a sector historically we've liked. It is one of the areas where India excels. You have one of the best generic pharmaceutical sector in the world, world-beating companies. And we've had significant holdings over time and made very good money on them. We are slightly more cautious in the short term, and the reason for that is the market is changing. And what I mean by that is there are now more competitors. There is much more pricing pressure. Companies are having to move much faster to stay ahead of the game. For instance, generic pharmaceutical pricing is falling high single digits in the US now. So whilst the market is still growing for generics, the price erosion is reducing a lot of that growth. So we're looking at, I think, a more tough environment for the average Indian pharmaceutical company. And to be fair, they're all saying now we need to move into biologics, more difficult to manufacture areas, more niche areas. And I think they're right. But the success of individual investments will depend, I think, on individual management strategies. I think the glory days of 20-30% annual growth are perhaps over. It's just a more difficult place to be than it was.
You spoke about public sector banks, but even private sector banks have got hurt over the last year because of these asset quality issues. Do you have significant holdings there, or are you wary of that entire space in general?
In general, we're wary of that space, and I think this is an emerging market sort of issue generally, is that very high quality growth companies attract very high multiples because people like the security, they like the visibility of the growth, and that's largely private sector banks in India. Those companies which are seen as very risky and very challenged, public sector banks, are very cheap. So as an investor, you have this problem where you have companies you'd like to own, you think they're pretty fully or fairly valued, companies which you really don't like, but actually look incredibly cheap, and that's India. You have the private sector banks are relatively expensive, the public sector banks are potentially quite cheap, although there's a lot of moving parts to that analysis. So for us at this point, financials is a sector where we haven't got much exposure in India.
What do you do with commodities? Because that's such a big call that you have to take in the emerging market universe. I mean, of course, you can take country calls like Brazil, Russia, and they've rebounded more than India. But even in India, you have a lot of resource companies which are going pretty cheap. But as an investor, as a portfolio manager, how do you tie in commodities into your investable universe?
I think the interesting thing about commodities at the moment was there used to be one overarching theme. So what you had was the very strong growth in China drove the whole commodity complex upwards. You had this very strong rally for several years in commodities. Then you had the slowdown in growth in China, and also you had supply catching up with demand, so we had overcapacity, so we had the great commodity correction. And now what we're seeing actually is much more divergent and differentiated. So for example, the oil price is up 80% from the bottom, the iron ore price is up 30% from the bottom, but actually aluminium and copper prices are up less than 10% from the bottom. Quite a lot of divergence. And I think going forward, what we're going to see is going to be very commodity specific. So for example, iron ore, there's a lot of supply, a lot of low-cost producers. Chinese are closing steel capacity. That looks like a difficult place to be. Zinc is quite the opposite. Zinc, if anything, mines will shut, supply may contract. That may be a mineral where the prices hold up relatively better. So it's becoming very specific by commodity and very specific by company. The companies with the best mines, with the lowest costs, with the best cash flows, will do much better than those companies with lower quality mines, higher costs, which still have a problem with cash flows. So it's going to be very case by case, I think, going forward.
So what are your big bets in India? I mean, are they relatively defensive sectors like information technology, or have you gone down the risk ladder out there?
Again, one of the interesting things to think about information technology was it was very defensive for many, many years because, as you know, these companies own euros and US dollars and have rupee costs. At a time of a weak India, their rupee costs are falling and they're benefiting from European and US revenues. What is happening just at present is that's beginning to change a little. So they're finding revenues harder to earn. They're finding it harder to beat guidance and to grow the companies. And that's a change in an information technology environment. It used to be, we give you 1,000 people to do your IT, and now the purchaser's saying, well, why don't you automate that? And maybe we only need 900 people. Well, if you automate it, and you only provide 900 people rather than 1,000 people, what happens to that 10% of revenue you've now lost? And so there's actually a structural change where there is some automation coming in there, and that's beginning to moderate the revenues. India, we think there are some interesting places. We do have one or two Indian IT names. We have some auto names where I think auto demand has been very restrained for some time, and we see demand coming back there, and you do have some very good auto manufacturers. We own one or two of the cheaper consumer goods manufacturers where we like the growth and we can actually sort of find the value. So it's a very diversified portfolio in India, which probably doesn't look too much like the market, and we're sort of quite happy with that at this point.
Do things like what's happening with the Japanese yen over the last few months and what it could mean for the currency devaluation in China, and do these appear as major risks to this emerging market spectrum to you?
What's happening to the yen is around that central banker thing we spoke about in the beginning, which is the central bank moved to a negative interest rate policy. The market said, as a banking system, how do you make money? How do you add capital when you have negative interest rates? So if you think about negative interest rates, if I charged you for putting your deposit in my bank, you might think about taking your deposit out, which would potentially destabilize that bank. In that environment, if you're a banker, you're going to make a lot of new loans. So there are a lot of secondary effects from negative interest rates, which are potentially quite frightening. And I'm not sure that this has really been thought through. So that yen weakness, I think, is somewhere around the market becoming quite uncomfortable with policy. And I think more broadly, central bankers were clearly a force for good in defending the world against catastrophe in 2008. They're almost now a force for instability, although they may not see themselves that way. So I think it's critical for markets going forward that they sort of extricate themselves from being sort of central to the argument and go back to where they always were, which was, in general, relatively peripheral to the economic argument rather than being center of it.
We've had 5-6 ordinary years in emerging markets. Do you think we still remain in that regime of a difficult overall market? I mean, I'm not saying bear market, bull market, but a difficult market, or do you think we are beginning to come out of that kind of a phase?
I believe there's evidence that we're beginning to see a turnaround. We can see the changes in governments, the changes in economic policies, the changes in what corporate managements are doing. I think that's a good indicator of what better times ahead. I think the trouble with that is you're fighting against various headwinds, so that's actually tough to do, and the timing is somehow quite difficult to predict as well. I would say the one risk facing all of us is simply China. And I think China is this very untransparent thing of great importance to the world. To give you an idea how important China is, China produces 24 million cars roughly this year. The US will only produce 12 million. And in many, many industries now, China is the biggest single driver. And China has got to go through this difficult transition from a very investment-led economy where they've been driving growth through heavy investment and rising debt to another way where their growth will not need quite so much debt going forward. But clearly that transition is difficult to do, and I think one of the great challenges of China and for the world will be to watch how China makes that transition. We would say that there are indications they understand the issues, so they're now cutting capacity out of their steel industry, their packaging industry, their coal industry, they're cleaning up debt at local governments. So there are things that they're doing, but they need to do a whole lot more, I think, to really sort of alleviate those risks. So I think China is actually a centre of us, not just for Asia or emerging markets, but globally for all of us. But one that's difficult to quantify because it's such an opaque place. It's very difficult to understand what the seven guys around the table talk about every day.
Pleasure talking to you, Archie. Thank you very much for your time today.